You're with ChannelVest, your expert in ETF strategies. We are diving in right now, and I mean diving deep into one of the most popular factor ETFs out there.
Right. And we're going to forget all the marketing hype you've heard.
We are exposing the hidden risks that, and this is not an exaggeration, could cost you $62,500 or more for every $100,000 you invest over the next decade.
Yeah, and we're not just, throwing numbers around. Our analysis today is based on some really objective institutional-grade research. We're talking 10,000 Monte Carlo simulations.
And a really rigorous fee comparison that, frankly, Wall Street prefers you don't look too closely at. Our mission here is simple: give you the objective truth.
Exactly. What this fund really offers versus, what it actually cost you.
Okay, let's kick it off with the title of our deep dive: Why MOAT ETF Could Destroy Your Wealth.
It's a strong title, but we stand by it. This fund is, as you know, famously marketed as the Warren Buffett strategy, all about companies with these sustainable competitive advantages, the so-called wide moat. But here's the thing. 90% of investors are getting the execution of this idea completely wrong.
They really are. And you can see it in the recent history. I mean, look, in 2023, MOE looked like a world beater. It crushed the S&P 500 with a 32.41% return. It definitely had its moment.
A huge moment. But that success story was immediately followed by a devastating reality check the very next year. And before we get to those, let's call them ugly number, we have to cover the fine print.
We always do. So let's look at the important disclaimer.
Okay, so just to be perfectly clear, understand that ChannelVest provides research and educational content only. We are not your advisor.
And we get zero affiliate income from any product we talk about.
Yeah.
That's really important. It's why we can be brutally honest.
It's why we can give you this independent analysis. It's all based on publicly available data. And as always, you must consult a qualified financial professional.
Absolutely. The data we're about to drop is just, it's so explosive. We have to get this out of the way first. Stick around.
And actually, before we get into the core data, I need you to do one thing. Hit that subscribe button and comment below right now.
Don't wait. Join the community now because the numbers are about to get truly insane.
All right, let's do it. Let's move on to the MOA hype, what everyone's talking about.
And as you mentioned, 2023 was a fantastic year for it. 32.41% returns. It beat SPY's 26.3%.
And that, of course, led to massive inflows. The assets under management, or AUM, swelled to over $12 billion.
$12.38 billion, to be exact. All focused on just 54 holdings picked for that perfect moat strategy.
It's a huge but. The story just completely flips when we look at the broader market rally that came next. So in 2024, MOAT returned only 10.73%.
While SPY soared to 25.02%. I mean, do the math. That is a massive 14.29% underperformance in 1 year.
That's not just a lag. You're missing an entire market rally. And that 14%, well, wait until you see how its long-term performance stacks up.
Yeah, that 14% drop is really just the tip of the iceberg. Looking at the numbers don't lie. MOE's the performance reality. The pattern just becomes undeniable.
The annualized returns, 15.25% over 5 years, 14.45% over 10. They look solid, but they're not spectacular.
Not at all. And they consistently lag the broader market over those same periods.
The trend continues right up to today. I mean, our year-to-date 2025 analysis shows MOA is only up 8.73%.
Compared to SPY's massive 15.80%?
The conclusion is just inescapable, right? MOA is a financial anchor when growth is thriving. It only seems to win when mega-cap tech crashes.
And it gets worse. It even lags its own index by about 0.59% a year because of its expenses.
So if the returns are lagging, the risk must be lower, right? I mean, that would be the trade-off.
You would think so. But you'd be wrong. Prepare for the Sharpe ratio disaster on this next chart.
This is where it gets really ugly. We're looking at SHOC, risk-adjusted returns reveal the truth.
And we are focusing entirely on the Sharpe ratio here.
Yeah.
It's the key metric, the measure of reward you get for every single unit of risk you take on.
And MOA's Sharpe ratio it's just weak. It's 0.56.
Just 0.56. Now, let's put that in context. SPY, the S&P 500 equivalent, comes in at 0.73. That is 23% better reward for the risk.
And then there's QQQ, the NASDAQ Q100 tracker. That's at 0.88. I mean, that is a shocking 58% better than MOA.
So for every unit of risk, MOA is delivering 23% less reward than the simple S&P 500.
Yes.
This isn't just underperformance anymore.
No, this is bleeding capital on totally unnecessary volatility. And we're about to show you exactly how high that volatility is next.
Let's talk about the volatility bomb. Higher risk, lower returns.
The annualized volatility for MOA, it clocks in at 16.26%.
And just for comparison, SPY is at 13.82%. VTI, the total market, is even lower at 12.95%.
So you are taking on 2.4 percentage points of extra risk compared to the S&P 500.
And for what? The beta is 0.96. It moves almost in lockstep with the S&P. The correlation to SPY is 0.88.
So you're getting almost no diversification benefit. You're taking on SMICAP risk, sector-specific risk.
And when SPY crashes 34%, MOA is right there with it, crashing 33%. But you're paying 15 times the fees for that privilege.
It's incredible. And this pattern isn't a fluke. We're going year by year now to prove it. Get ready for the annual returns battle.
Right, let's look at the annual returns battle. Who's really winning? This really clarifies the pattern.
Okay, so 2019 MO8 wins, plus 34.79% versus SPY's plus 31.49%. A good year for it.
But then look at 2020 and 2021. MO8 loses both times, badly. In 2021, it was over 4.5% behind SPY.
Then the 2022 bear market hits. MO8 wins by losing less. It's down 13.65% versus SPY's negative 18.11%.
And then the 2024 AI dominance, MO8 gets absolutely destroyed. It's up only 10.73%, while SPY is up over 25%.
So the pattern is crystal clear. MO8 only wins when mega cap tech gets crushed. When growth is happening, it's a financial anchor.
And if you think that performance lag is bad, let's factor in what we're calling the fee apocalypse.
Oh, this is critical. But before we get to the jaw-dropping numbers on fees, I need to ask you again. Subscribe now.
And comment below if you currently hold MO8. Seriously, we want to hear from you. What's your thesis?
Okay, on to the fee apocalypse.
Love.
Death by 1,000 cuts.
Multihisi's expense ratio is 0.47%. And to a lot of people, that sounds small. It sounds like nothing.
It's not nothing. It's a slow bleed. Let's look at the 30-year cost on just a $10,000 investment. OK takes $1,575 in fees.
And VOO, or SBY, about $99. That is a 15.9 times cost multiple. It is just unforgivable.
It really is. And here's the real wealth impact. Let's say you invest $100,000 over 30 years.
With MOK, your ending value is around $660,000. But with VOO, it's over $761,000.
That is a $100,472 loss. That is your money, your wealth, transferred directly to the fund manager.
And that's just the fee you can see. That doesn't even count the hidden cost of taxes.
Which brings us to the hidden tax destroyer, 50% turnover rate. The true cost of MOA is closer to 0.62%.
This is such a critical point. If you hold MOA in a regular taxable brokerage account, you need to listen to this.
The fund's rules force it to constantly rebalance. It's selling winners to buy losers. And this generates a massive 50% annual portfolio turnover.
50%. That means half of the companies in the portfolio are kicked out and replaced every single year.
For you, the investor, that means you are constantly getting hit with realized capital gains. This creates an estimated tax drag of 0.15% per year.
Which is 15 times higher than a low turnover fund like SPY or VOO.
Yeah.
Over 30 years, that's another $10,000 to $15,000 lost to taxes.
And the irony is just, it's unbelievable. How can a wide moat strategy, which is supposed to be about stable long-term companies, have a 50% turnover rate?
It completely betrays the entire premise. It's absurd.
So if it costs so much and it's so tax inefficient, you'd at least hope it diversifies your portfolio, right?
Well, prepare to have the diversification myth. MOA doesn't actually diversify, completely shattered.
The correlation matrix here tells the whole story. It's an uncomfortable truth.
MOA's correlation to QQQ, the tech index, is 0.92. They practically move in perfect lockstep.
And its correlation to SPY is 0.88, massive overlap. So adding MO8 to your core S&P 500 position gives you basically zero diversification.
You're just adding volatility and cost without reducing your overall portfolio risk.
The only real diversifier we listed on that chart was SCHD at a 0.65 correlation. A simple 60-40 SPY SCHD portfolio is a much better diversifier.
Okay, so now that we've seen the high cost and the low diversification, let's look at the catastrophic long-term wealth destruction in cold, hard numbers.
Let's do it. We're looking at the 20-year wealth projection, the 904K swing.
We ran the numbers on $100,000 invested over 20 years. In the bull case, the best case scenario, SPY still has a $140,000 advantage.
But the bear case is catastrophic. In that scenario, SPY ends up at $1.91 million. MO8, just $1.01 million.
That is a $904,000 advantage to SPY in the bear scenario. This is real. This is based on its historical volatility and its fees.
It fails you when you need it most. And if you still don't believe us, well, we ran 10,000 Monte Carlo simulations. The results are definitive.
Yeah, let's look at the Monte Carlo reality. 10,000 scenarios don't lie. This removes all doubt.
The math does not lie. Over 20 years, SPY wins, meaning it ends with more money. In 62.5% of all 10,000 scenarios.
MO8 only wins in 37.5%. And the median outcome, the most likely result for SPY, is $1.8 million. It's significantly higher.
So the math just does not support MOA as a core holding, period.
So where does it fit, if at all? Let's give you an honest framework for that.
Right, our portfolio allocation framework, where MOA fits, if at all.
Okay, if you're a conservative investor, maybe age 60 plus, our advice is simple. Avoid a 0% allocation.
For a moderate growth investor, we'd say a max of 10%. And if you're aggressive growth, max 5%.
And the key here is that it should only ever be a satellite position, a small tactical bet.
And crucially, only in a tax-deferred account, an IRA or a 401k. That 50% turnover makes it a nightmare in a taxable account.
And all this data leads to one inescapable conclusion, which we've summarized in the honest verdict: 3.51 rating.
That's right. For the average investor, MOA gets a 3.5 out of 10. It is a high turnover factor timing bet that's just disguised as a quality fortress.
It has worse risk-adjusted returns, higher volatility, that astronomical true cost of about 0.62%, and, as we saw, zero diversification benefit.
And this is why we saw that nearly $4 billion institutional exodus from the fund. The smart money is leaving.
The bottom line is, a simple combination of VOO plus SCHD delivers better results for 90% of investors. It's cheaper and it's more effective.
We've revealed the truth about Marinate, but we've got one more massive smart beta ETF in our sights for our next deep dive.
So let's look at the final slide. Don't miss our next deep dive.
Here at Channel Best, we cut through the hype with real institutional grade research. And next time, we're analyzing another smart beta ETF that Wall Street loves.
But our data reveals some shocking underperformance potential.
So subscribe to Channel Vest right now, hit that notification bell, and please comment your portfolio questions below to join the community.
And remember, this is educational content only.
Yeah.
You have to consult a qualified financial professional.
But before you go, think about this. Given MOA's nearly perfect 0.92 correlation to QQQ,
You need to ask yourself a serious question. Are you really paying 15 times the fees and accepting all that extra volatility just to get a slightly worse tax-inefficient version of the tech index?
think about that before you allocate.